Good afternoon. Welcome to this webinar on the future of risk. Key risk trends and strategies in 2020 and beyond. I am Sylvie Davidson, and I will be moderating this session. We will be discussing the risk and regulatory landscape, technology use cases, and operational risk and compliance. This webinar is a prequel for the Asia Risk Congress, which is the Asia Risk's annual flagship event to be held virtually November 24th to 27th. I would like to ask our four panelists now to introduce themselves. Thank you. Over to Sophie first.
Good afternoon, Sylvie, and thank you. I am Sophie Marnier-Foy. I am Director in Product Management, working at Calypso Technology. In the past few years, I've been working on our risk solution, namely clearing risk, counterparty risk, and regulatory risk, and I'm looking forward to this panel today.
Thank you, Sophie. Michael?
Hi, my name is Mike Gibbs. I'm the president and founder of SureStep Risk Management. We are a global consulting firm specializing in governance, risk, and compliance, and offers everything from infrastructure solutions through to consulting on the topic. And thank you for having us as part of this.
Thanks. Gaurav?
Hi, good afternoon, everyone. Thank you for having me on this panel. My name is Gaurav Kapoor, and I look after the sell-side risk and valuations business for Bloomberg and APAC. This entails supporting our customers in the region with solutions across front office risk, market risk, credit and counterparty risk, collateral management, hedge accounting, not to mention the underlying data and the valuation services for the complex derivative portfolios. Thank you.
Thanks. And Vasil?
Thank you, Sylvie. My name is Vasil, and I'm the Deputy CEO of the Mine Superannuation Fund. We're an 80-year-old $12 billion pension fund designed to serve the needs of the coal mining sector in Australia, if you haven't been able to tell by my accent. Up until May this year, I sat in the role of the Chief Risk Officer, and prior to this, I worked in risk and strategy roles for some of the larger Australian financial services institutions, Westpac and CBA. And thank you for having me. Looking forward to the session.
Thanks very much. So let's start with our first polling question. What are the emerging risk factors that impact the APAC markets the most? While you are answering this, the first question for our panel, what is keeping risk managers awake at night? Michael, would you like to take that one?
Yeah, sure. I think there's a number of different things that are affecting risk overall across the world right now. And certainly in the ASEAN region, there's a number of factors. To me, there's a couple of them come down to there's geopolitical factors. Seems to be one of the bigger and hotter topics of the day right now in terms of how, various countries are trying to find a common regulatory framework and trying to do that against a backdrop of fairly turbulent times, where there's a lot of uncertainty in the region that's causing markets to fluctuate and causing a lot of angst in the business world. And trying to find a path for how do you manage risk in your organization against that backdrop is a little challenging. So I see that as being the biggest consideration right now for the region.
Okay, thank you. Thanks, Michael. Gaurav, any thoughts from your side?
Sure. Thanks, Sylvie. There's so many things that are really keeping risk managers awake at night. And as you can see, my fellow panelists are already leading the way today by dialing in from Toronto and California. If I was just to focus on the sell-side industry, I think the biggest challenge for risk managers is the suite of regulatory changes that are really coming through over the next 3-4 years. LIBOR transition is something that the entire industry is working on at the moment, not to mention various ongoing projects on uncleared margin rule, revised market risk framework, standardized approach for credit risk and CBA. Although the deferral of these timelines have actually given some kind of reprieve when these Basel standards are delayed by a year, once everyone really realized that this is the new normal that we are living in, we have seen most of our customers continuing to invest resources into these projects. And essentially, these projects will require an overhaul of both systems as well as processes.
Thank you. We just can see now the polling results, which is quite interesting. Geopolitical risk is right ahead there. Regulatory risk is not on top anymore. So I think that's kind of a change in landscape. Vasil, would you like to add to this?
Absolutely. Thanks, Sylvie. Yeah, the results are quite interesting, aren't they? I just assume that we have geopolitical risk as a result of some of the global leadership, and I just move on. But well, that's very interesting results. Apologies for the sidebar. Look, Sylvie, from my perspective, what keeps me up at night, other than my 2-year-old, generally relate to the importance of, or the elevation of, non-financial risks, probably to the level of financial risks in the context of operational performance. A good illustrative example is, particularly in financial services, while conduct risk has been significantly focused on in the recent period, it is becoming obvious that risks in the event of a 1 in 1,000, 1 in 10,000, such as business continuity, liquidity, some of the strategic risks are becoming more top of mind. For risk managers and people working in the risk profession, it is obviously and ultimately easier to quantify and manage risks that are more likely to happen, as they represent the bulk of risk events. However, it is the pandemic, kind of loss of infrastructure, people, loss of sales, some liquidity issues, or these black swan-like events that are starting to occur. So for us, our view is that a number of risk managers probably haven't built out their frameworks comprehensively enough to account for these scenarios. So while the core of their frameworks and their operational risk profiles are quite resilient, it's the outer edges that are starting to suffer. So just to summarize, I think the pandemic in and of itself has tested the resilience of some of the outer bounds or outer bands of our own operational risk management framework. And from my perspective, that keeps me up at night, because I know that while we're good in the core, around some of the outer edges, we're not necessarily as resilient or as strong.
Thank you very much. So should we go to our second polling question, which is, what regulatory developments take up most risk resources? In the meantime, for our panel, what are some of the key regulatory movements that are impacting risk strategies? Gaurav, we would like to take that one.
Sure. So I've just hinted on the LIBOR transition as a topic, right? And this is a huge industry and regulatory driver. How if I were to pick up one of my favorites, right? I would say that the revised market risk framework under the Basel III regulation, or FRTB, would be the one which I would really pick up as impacting the risk management strategies the most for the sell-side institutions. Forget the complexities that will really be required if someone was to actually adopt the internal models approach and specifically coupled with regulatory approvals if they were lucky. But just talking about the standardized approach, which is required for all the entities under the Basel market risk regime, if you look at the workflow of a sell-side institution, it kind of entails looking at various different things, right? So first is how they consolidate positions across multiple systems. The second is data acquisition and enrichment of the data, looking at the underlying terms and conditions, classification of that data, factor mapping, and calibration of underlying curves and walls, etc. These underlying data and curves then essentially need to work with pricers to generate the instrument level analytics in Greeks. And then you have the issues of bucketing, netting, and hedging that everyone needs to look into, right? Lastly, kind of that translates into the capital charge calculations across the sensitivities-based method, default risk, and residual risk add-on. And then they also need to look at what kind of user interfaces will they need to have to actually consume the outputs of these data points, right, in a more interactive application environment. Actually, the last point is really quite important if you look at it, because if I was to just look at, let's say, the index look-through as a requirement, the standardized approach, what it really says is that it kind of prescribes that for indices, funds, and their derivatives, they need to be bucketed on underlying names, right? And a complete FRTB solution must really identify and incorporate the constituents of an index that it is exposed to. Now, Bloomberg Solutions really provide that for a bank, but any bank that is really involved in this business, and actually APAC is a huge structured products market and derivatives on the underlying indices. The difference between the applicable capital charge for banks who can do this versus who cannot is actually huge. And what we're really finding out is in some cases, a business could really be non-profitable and unviable. So what I really wanted to highlight over here is there are various regulatory regimes that are impacting clients in a different way. I've just spoken about one. Each has its own nuances about it, but the complexity is similar across different areas of a bank's business.
Thank you. Let's look at the polling results. Okay. I'll pass on to Michael, actually, if you have any comments on that.
Yeah, I don't think there's any major surprises in these results, right? I mean, one of the biggest challenges in APAC is that there are so many different countries, and every one of them is trying to set their own standards for various components of the regulatory landscape, right? So every one of them is saying, here's how we're going to manage data, here's how we're going to manage quantitative risk, here's how we're going to manage, business resiliency risk, here's how we're going to manage all these different aspects of risk all around. And every country seems to have their own way of wanting to do this. And it makes life very difficult for a CRO who's doing business in multiple countries. Most of our clients are doing business in many countries, some of them in literally over 100 different countries. And how they manage the different regulations and how they do across the world is an all-consuming challenge for many of them. And the challenge with all that right now, the one that seems to be causing the most headaches, is around data. So again, the results of the polling really doesn't surprise me very much. You have data residency issues that change, again, from country to country to country. And it makes it, again, extremely challenging for any organization to come up with a strategy for how to address it appropriately. So, again, no big surprises in the polling questions. It's pretty much exactly what I would have expected to see. Everything from each country to individual states coming up with their own rules, and everybody has to follow them. And, it results in massive IT expenditures, massive expenditures in the risk department for companies. And it really becomes a huge cost center for organizations to manage all of this. So while nobody would sit back and say that, hey, compliance isn't important and you're spending too much money on it, the reality is that it's making the bar to entry for most organizations that much higher for them to achieve. And so as a result, you see a lot more of that consolidation into the larger organizations where they're the only ones who can really manage to put together a regulatory response for an industry, and so smaller players end up getting squeezed out or absorbed or whatever by the bigger ones, and as a result, all the solution providers that we have here on the phone and so on. I mean, we're all concentrating on the bigger parts of the market because they're the ones who are simply the only ones who are able to address these regulatory requirements across multiple regions.
Thanks. Sophie, any thoughts?
Yes, and actually it does not surprise me either to see that there is this big concern about the regulatory market fragmentation in APAC. What I've seen very impressive in those global firms we are working with is the variety in the adoption of the Basel III framework, whether it's the UMR adoption or the FRTB or SLTCR. And we can see how various countries or various institutions will have a very different pace in terms of adoption. I think also what's very challenging in APAC is the LIBOR transition, right? Because it mostly affects discounting for most of those countries. So you end up with having to adjust to the RFR discounting, and we've seen the Ester discounting coming up, and now we are preparing for the SOFR discounting. So it's actually quite challenging to have this agility of being able to do things differently in different countries and at a different pace, right? Now, I would like to go back to your initial question, which was what are some of the key regulatory movements that we are seeing? And I think what's pretty interesting is to look at not only the list of all those new regulations which are coming from the Basel III pillars, right? So we have UMR, we have FRTB, we have SSTCR, we have the new CVA framework. It's a long list, right? And what's interesting is to look at how firms are actually managing all those regulatory process in parallel. And what I've seen is there is actually a trend of doing achieving the compliance in phases. So the first one is being compliant because that's the minimum required. But that's not enough. Why? Because if you're just trying to be compliant, it will kill your profitability. So very often after compliance comes consolidation. Because if you consolidate your system, your data, and your calculation, you will reduce your cost. And typically the step 3 in that regulatory adoption would be optimization of the cost, optimization of the margin, optimization of the capital charge. So that would be my view on that trend in terms of adoption of the new risk regulation.
Oh, thank you. And Basil?
Thanks, Sylvie. I'll do my best not to cover old ground. I think the topic has been well litigated. Probably the only comment is in relation to enforcement. And I'd probably say in general in most jurisdictions that we deal with obviously cross-jurisdictional and also into Southeast Asia, there has been increased resourcing for enforcement agencies, prudential regulators, or alternatively kind of securities regulators in response to increase community expectations. And fundamentally, you don't necessarily give an enforcement regulator funding unless you're looking to find something. And what we are finding, particularly in this jurisdiction, is that there has been increased sophistication in relation to the regulators, and they can more easily identify weaknesses in frameworks and processes. So not only now is it how to describe it, it's not necessarily regulatory movements and what they're doing to some of the regulated bodies. It's actually the way in which they're doing it, which is more sophisticated. They're drawing a lot of talent from the private sector as well. And we're finding that a lot of our prudential regulators with APRA, our enforcement regulator with ASIC, particularly in the Australian geography, are just getting better at their jobs, which is good because it's a really good thing because it obviously raises standards. But separately, it's also becoming exceedingly difficult to continue to stay ahead of the standards as they're moving so quickly. So that's probably the observation from the Australian jurisdiction.
Okay, we have some questions from the audience. How can authorities help to reduce the regulatory fragmentation? Who would like to take that up? Anyone?
I live in Australia, Sylvie, so we're pretty isolated here. I don't think I'll be able to help.
Michael, I think that one you can take.
Yeah, I'll take a stab at it. I think what most companies would really like to see from the regulators is a bit more of a coherent and consolidated approach. Everybody's doing it in a bubble right now, and to use a term of the COVID era, I guess. But everybody seems to be doing things in their own little bubble and coming up with their own set of rules. And of course, everybody thinks that theirs is, to use a Canadian expression, that everybody thinks they're a special and unique little snowflake. And the reality of it is that all of these various regulators in all of these various jurisdictions are all trying to achieve fundamentally the same goals. they are all trying to prevent crime. They're trying to prevent fraud. They're trying to prevent money laundering. They're trying to prevent all these various crimes, and trying to ensure that the various institutions that are beholden to them are fundamentally behaving. So everybody can agree that the outcome is a common one that everybody is trying to achieve, regardless of the jurisdiction. However, there's so little communication between the various jurisdictions, between the various countries, between the various regulators. They all go to conferences and all talk about, no, hey, what's up, what we're trying to do, but nobody's actually getting into a room and saying, all right, let's come up with a common framework and a common theme that we can go back to various parts of industry with and various corporations with and say, here's how you should be doing risk across ASEAN, for example. And there's still so little cooperation at that level. And I think until that level of cooperation improves, it's very, very difficult for anyone on this panel or anybody who might be listening to really find an easy way forward in this regulated environment.
If I was to just basically add to what Mike has just shared, I completely agree with Mike in terms of how there is very little communication, or even if there is communication, it doesn't necessarily feel as if it's coordinated. But actually, if you were to look at it, APAC as a region is quite fragmented in terms of how developed the financial markets are in each country, right? So we have got like the developed economies, we've got the emerging economies, and we've really got like financial markets that are not yet geared up in terms of having any kind of infrastructure in place or liquidity in place to really kind of comply with these global regulations that are coming through. So we need to be conscious of the fact as well that naturally each economy is going to kind of, or regulatory framework is going to adopt these rules at a different pace. In some cases, the underlying market infrastructure itself is getting developed as we speak, whilst in a few places, the actual trading of these underlying instruments has already picked up, and people are kind of complying with these regulations, right? So I think we have to appreciate that fact, and like Mike said, we all know that as an outcome, eventually everyone is going to end up being compliant. At what pace? That needs to be respected by the market participants, because you really can't force a market go down the route of, let's say, even from a, the LIBOR transition conversation, even from that perspective, you can't necessarily force markets to really go down the route of risk-free rate curves and kind of adopt a new alternative reference rate environment when there is no underlying market for it or liquidity for it. So it's just something that I wanted to highlight, that this is something that we will need to live with.
Thank you. We have a second question from the audience. Could authorities develop something similar to general accepted accounting principles like GAAP? Basil, is you going to take that?
Yes, thanks, Sylvie. From my perspective, I think that would be very difficult to do. I think we all know as risk professionals that risk is just as much an art as it is a science. And unfortunately, when we're looking at kind of multi-jurisdictional attitudes towards risk management, we know that compliance management in and of itself is a much older discipline, and risk is fairly recent, realistically, particularly in the last 2 decades. And where it does require a degree of technical skill, the softer side or the softer skills associated with being an excellent risk professional are influenced by things, for example, not similar to accounting standards, for example, culture, the maturity of markets, the maturity of the regulators in these individual jurisdictions. It's not as simple as it's not paint by numbers, I think, which we all appreciate. So while I do think that development of standards, and we have the ISO standard, obviously, which is a very basic starting point, and obviously the profession is maturing in and of itself, I think we do need to acknowledge that it is a fairly immature profession, and in a lot of jurisdictions and similarly in industries, they're still even trying to pull risk out of compliance as a profession in and of itself. So I don't necessarily think that type of step to uniformly implement standards cross-jurisdictional would necessarily help in this particular space.
Thank you very much. I'd like to pass on now to the next question, which is about technology. So when looking at technology tools that are transforming risk functions, what should firms consider to maximize tech investments? Sophie, would you like to take that on?
Yes, thank you, Sylvie. So effectively, right now, firms have quite a few challenges. Because on one hand, they need to do more when it comes to risk. So they need to do more risk calculation, more computation, real-time, intraday, way more than they were before, right? At the same time, there is a push and a trend to reduce costs in managed TCOs. So what can they do, right? On one hand, they have all those new regulations, all those new risks to compute all the time, and then they have to reduce costs. So there are actually a few ways to handle that. Some of those solutions actually started some time ago, but they're still quite good to have. So it's good to have a strong solution where you have a very strong calculation grid, data grid to do those calculations. But then you can go beyond that. So if there is a need to have real-time or very frequent update in those risk metrics, but a very smart way to handle that is to do an incremental calculation. It's not always very simple because the risk calculation is not always additive. So you might have to find a way where you do your incremental calculation at the latest possible additive level. It could be a P&L vector. In the case of market risk, it could be a sensitivity. In the case of SAMR or UMR. So you find that spot where you can leverage an incremental calculation, and then you build on top of that, and you clearly optimize how much you're going to use your risk platform. But at the same time, you save on your risk infrastructure, and you get way more in terms of the accuracy of the risk metrics to produce, right? So on top of that, what's also quite a useful trend is hosting the solution in cloud, right? That's a key way to manage your TCO. And I would say finally, what also helps firms to solve those tech challenges is to consolidate. And when you look at all those regulations we've talked about, when you think about them, yes, you have risk calculation, but you need inputs from collateral, from clearing, from regulator information. If it's all in one system, it's going to be much cheaper to manage and to run. So those are the key things that I've seen as trend, and that would really help risk managers move forward from a technology perspective.
Thanks, Sophie. Michael, any thoughts on that?
I think the key trend that we're seeing in the governance, risk, and compliance space seems to be all towards automation, which is something that amazingly is somewhat new to the space. It's been traditionally all done with a pile and a mountain of various spreadsheets, and that seems to be moving away pretty drastically and pretty quickly now, which is a very welcome trend. So people moving more towards specific solutions that can eliminate any of the human error, or at least reduce it as much as possible, while aggregating various automated systems and data sources all into one cohesive report to the regulators has been a really, really key trend as well for us as well, outside of the quantitative risk area as well.
Thanks, Michael. Gaurav?
Sure, thanks, Sylvie. So I couldn't really agree more with what Sophie has mentioned, because really looking ahead, financial institutions will need resilient, secure, and scalable technology stacks to operate in this new complex environment, and actually remote working environment, right? So as the pandemic or the coronavirus outbreak continues to disrupt markets and economies, the finance industry is really experiencing a huge tectonic shift across a wide spectrum of areas. And it has definitely accelerated the technology race in the financial sector as companies adopt new operating models, right? So those who really relied on cumbersome and deployed systems are having to rethink how they can best compete in, first, a challenged profitability environment, and second, a more complex regulatory environment that they are dealing with. As this is definitely helping move towards like hybrid cloud capabilities that will allow them to combine their own systems together with a hosted capability from other vendors to provide the new technology capabilities that they really need, right? And what we really want, or what the customers really are asking for, is from a system point of view, they want to move away from the whole point-to-point architecture, system architecture that was the legacy systems that they used to deal with, to a fully scalable architecture with a central data bus, right? Now, this takes time and money, but most of our customers are really operating with that vision and moving towards more flexible and modular solutions that allow them to kind of evolve as the market needs evolve. As a technology tool and trend that we have seen in the past few years, one thing which I really wanted to point out was how we've invested heavily in our capabilities to deliver risk analytics via application programming interfaces, or APIs, as we know. And there is a growing trend in our customers really leveraging on these APIs to both manage front office environments and front office risk requirements and their systems capabilities, right? So, for example, for the IBOR transition piece, if you look at, everyone has really invested quite a bit in terms of treasury systems over the past 20 years. When the OIS framework came through, people kind of graduated from just LIBOR discounting to OIS discounting and so on and so forth. But the legacy ALM systems, the legacy loan cash systems were kind of like the ignored child, so to speak, right? The biggest challenge is actually on the topic of IBOR transition is from a systems perspective, right? So we've kind of helped out some large institutions essentially not to spend any resources on upgrading their IT systems, and actually just query or expose their underlying trade parameters in an API environment, query the risk engines, and consume the outputs for their operational and risk requirements. So I think that's something as a trend which is really interesting that is emerging.
Thank you. So we have a question from the audience. Which risk system providers have leapfrogged the competition, and what are they offering which is truly state-of-the-art? Sophie, would you like to take that?
Yes, I think it's kind of a key question, because as we have seen with Guru's answer and our answers, there are many challenges. And I think some of the great solution we have seen coming up is along the line of that need for optimization, for being able to actually navigate through those new requirements for cleared, unclear margin, management of all your XVA additional spread. So the solution there is a very strong and powerful what-if tool. And you can have it pre-trade. So before entering any transaction, being able to assess what will be the total cost of my trade. So not only my price, but what will be my CVA, my MVA, my KVA, and then should I clear, not clear that trade. And very importantly, those tools should be there not just standalone at trade level. They should take into account your existing position, your existing portfolio, to give you the true incremental either saving or cost that you would generate before doing that transaction. That's pre-trade. And then on top of that, you also need to have post-trade. So as you can see, an entire framework of pre- and post-trade optimization is one of those new tools that came up to the market, and that will clearly already save profitability. So that's what I would highlight as one of the new tools that came up to the market. I would maybe highlight another one. In all that world of uncertainty, what's very important is to be able to release at any moment of time an update, a new module, a new margin methodology, a new set of weights because backtesting results have demonstrated that the current weights are not enough, right? So that possibility of releasing modules and that very quick time to market, I would say it's the second very big strength that a vendor or technical solution can bring to firms.
Thank you very much. So let's move on to the next polling question, which is, how much is your firm using AI? And to the panel, how can we make the business case for AI? Any special opportunities or pitfalls you are seeing? Michael?
So AI is a interesting one. So it's one of those technologies where the promise so far seems to be much more impressive than the actual delivery. And while there's certainly a couple of use cases in Risk where AI can make a significant impact, I've yet to see it really harnessed properly. Outside of some really impressive POCs, but outside of some demo type of environments, I haven't seen many companies really embracing it very well. The key use case when it comes to regulatory change, especially, comes down to having an AI with the ability to read and essentially comprehend, in quotation marks, a vast quantity of legal or regulatory data, and essentially interpret that for a given organization. So an organization might be using an AI to read all the regulations that are coming in in their jurisdiction, and then use the AI to essentially find equivalent risks that might be exposed, and then maybe suggest potential controls for them. And what that does essentially, it makes for a time to implementation of a new risk framework that much quicker, simply by eliminating an awful lot of the legal requirements and legal reading that's involved in it. So that's one application where I've actually seen some very good use cases, both from IBM and ServiceNow, where they've done a really good job of being able to take and read a lot of data at once and be able to parse that into something useful. But outside of that, I wouldn't have an opinion in terms of how it relates to the quantitative risk side of things. And, probably Sophie or Gaurav would have a better opinion on that side of things. But in GRC, so far the applications and actual use cases seem to be fairly far between at this time.
Okay, thank you. And we've got the polling results now, which is actually quite encouraging, 20%. Gaurav, you want to take that on?
Sure. And these are not surprising at all, right? I mean, I guess not at all, and 20% kind of truly reflects the journey for our customers in APAC when it comes to really artificial intelligence and NLPs and so on and so forth. With the increased market volatility and liquidity stress that we've seen, data is really becoming vital to understanding the current market dislocations, right? Just as an example, like during the stressed market environments in March and April, we saw market data ticks spiking from, on an average, like about plus 100 billion ticks per day to more than 250 billion ticks per day. So really, automated data certainly offers institutional clients more control and insight into managing these risks and making informed decisions, right? And increasingly, these companies are deploying new technologies to really become more cost-effective and can make sense and act upon huge swaths of data that are coming through the pipes. Now, as a company, we've been working with AI, machine learning, and natural language processing tools for a long time. Just as an example, Bloomberg users can go to a function that gives them just automated intelligence on demand. Essentially, it's just generating an instant text snapshot from the data warehouse, where each report allows you to review, save, share the latest status and drivers of the underlying instruments or indices in question, right? We've also invested in LP tools to augment the sales trader workflows, essentially recognizing what the queries are coming through and and looking at the underlying position database and coming up with suggestions in terms of what could be the liquidity that needs to be shown to customers. Our customers also need that particular workflow to interact seamlessly with the position management systems that are really generating customer intelligence to help with their profitability, right? When it comes to pure risk management, and that's something which Mike and I were discussing the other day, the main demand and adoption and adaptation of AI and machine learning continues to be in the front office space, where there has always been a tussle essentially between what we call speed versus accuracy, right? So if we can generate quality risk numbers, but at 10 times the speed, whilst we also save on computational power, that's really the win-win situation for everyone. I was just reading an interesting article recently where quants were looking at differential machine learning. Essentially, it's a combination of the AAD technique for example, for XVA, the adjoint algorithmic differentiation and neural networks that essentially can find patterns through the use of pathwise differentials for various risk factors across the data set to generate the CV and XVA numbers quickly for extremely complex derivative products, right? So American options and autocallables and so on and so forth. Essentially, if that kind of stuff can deliver the accurate risk numbers, but 100,000 times faster than the classic Monte Carlo simulation techniques, then that's really what we're really talking about in risk management, that AI and machine learning can be applied and really change the game for the industry.
Thank you, Gaurav. We have now another question from the audience. Is artificial intelligence a risk or a tool for risk managers? Michael, Gaurav?
I can. And I think it's an amazing question because effectively on one hand, you always want to compute more and more numbers and faster, right? But there is a huge risk because if you don't do it correctly, and if at the end of the day, those scenario shifts you're going to generate, or, for maybe the purpose of XVA or for the purpose of FRTB, if you generate some inputs that are incorrect, you are going to have incorrect metrics and not be able to at all manage your risk. And I would see another risk is the more data you have, the more complicated it is to explain what was used to calculate a specific number, right? That drill down that is so important when you manage risk is going to be more and more challenging the more data we have. So, of course, we have to go toward using AI and toward more and more data because that's how we're going to optimize risk. But we have to be very careful and do it in a way that is manageable so that we don't lose in the sea of numbers the accuracy of that validation and risk management we have to do. That would be my
Thank
answer.
you. And the next question is actually also connected to this. Maybe you can answer that too. How do we verify the results from AI is correct? Well, Michael, you just put up your hands for that.
Aside from educated guessing, no. I think this really kind of comes back to the whole notion of AI in general, right? AI is not a solution in and of itself, right? It is something that can be added to a solution. It is something that can enhance a solution. And so I think the framing of the topic, I think, is a little off. Like I have sat in meetings where we've had clients say, oh, by the way, we would like AI to take care of our risk management. That's not the way it's going to work. That's a bit of a misunderstanding of the whole notion of it. Again, AI is like having the world's most precocious 4-year-old child in the room. They can learn a lot really, really quickly. There's still a vast effort that has to go into educating it and ensuring that it's doing things right and ensuring that it is error checking against itself. And then how is that error checking happening and so on. So educating the AI as part of an implementation or deployment effort is really a huge effort. And it all comes back to, again, as the initial question, which is how do you check to make sure that the results are right? Well, you have to teach the AI what the right results look like, so it can look for them and understand how to make them, how to achieve them. And without that training and without that care being taken during deployment, it's very, very difficult to get results out of an AI that are going to be useful. That said, there's some brilliant tools out there for educating an AI and ensuring that it can do the job properly. But I think it's really important for people to understand that AI is not a solution to all of their problems. If you have the initial problems, you're still going to have those problems after you have AI. AI just might help you find a resolution to them much more quickly. And if you do a really good job of implementing it, you won't go broke and it will actually help you. So that's the key thing with AI. So I think people need to just maybe take a step back and think about, what is this going to be accomplishing for them, rather than simply saying, I'm going to have AI fix this problem. AI can help you. It's not going to fix the problem, make it go away. It might accelerate your ability to manage it. That's my best take on it.
Thank you very much. So let's move on to operations. We have our next polling question and the last one. With regard to operations, what are the main priorities for your firm? And for our panel, what are your recommendations on operational risk proof during the current global crisis? Basil?
Thanks, Sylvie. I'll be interested in the poll results as well, obviously. I don't think most risk managers think about this, but comprehensively enough, but you do need to make sure that you're focusing on compliance risk and you have robust and voracious frameworks to manage compliance risk, as well as some of your operational risk frameworks, to the extent where you do have all of your obligations identified and linked to key controls and everything mapped in your ARM. I think it was good to hear the discussion previously from the other panelists on AI, and I do think a lot of risk managers get very excited about some of the newer, what I describe as risk administration tools rather than risk management tools. And I think there is a delineation between the two. And I think to Michael's point, I think a lot of these tools are helping us administer risk better, but it's not necessarily helping us manage risk as well. So that's probably the first thing, particularly in the global crisis. Similarly, organizations do need to invest more. I don't think people or larger organizations or senior management understand that risk is actually a forward-looking discipline, not a backward-looking one. And there is a delineation there. Its real value is not necessarily telling you what has happened. It's probably what's going to happen. It's more kind of windscreen rather than rear view mirror. And I think risk managers are doing a very good job at trying to demonstrate the value that they're adding, but they need to constantly pitch for resources, and I think increasing resources in this particular area is important. And then similarly, though, to get into the nub of the question, how do you make sure you're operationally kind of risk-proof or compliant in the context of the pandemic? I do think you need to focus on the things that matter. And obviously our jobs were this big prior to the onset of the pandemic, and now they've almost doubled in size, and the criticality of the roles has been brought to the fore. And my personal view is that you can't really do everything. Sometimes actually increasing resources could actually provide certain diseconomies of scale as well between onboarding, getting individuals up to speed, the overhead associated with large spans of control. So a number of matters in relation to risk management or risk issues aren't necessarily solved by people or money or systems. Sometimes, a lot of the time, they're solved by actually quality, maturity, and also vision and direction from senior leadership, both at the board and senior management level. So just to probably answer your question more directly, I think not taking the eye off ball of compliance during the global crisis is important. I think obviously you need to continue to invest in the function, but also you need to focus on things that matters and really prioritize. I think that's quite important.
Thank you. So let's look at the polling results. Sophie, any comments?
It's quite interesting actually that the remote working was not the top one, but that the accelerated digital demand was actually the top one. But at the same time, you can see that B and C are almost equal in terms of the results. So effectively, those are key questions that actually took place at a time where already for risk managers, there were so many new challenges, right? So when the COVID-19 crisis hit, it was a huge liquidity challenge. It was a world with an unprecedented market volatility. So for a risk manager, before thinking of how the team was organized and how they had to manage the virtual and the remote way of working, they first had to, one, manage the new market volatility, which means a new way to manage market risk, because the stress and the scenarios had to be different. It was also a new way to manage counterparty risk. We know that the risk of default was acute. There was a need to actually work on that. And then on top of it, there was the relief provided on some of the Basel III regulation, namely FRTB and UMR, which was, yes, relief, but also disruption because the plans had to change. And I think the biggest challenge for the risk managers was to actually be able to actually make decisions and change their pattern of working right away. So basically, they had to somehow be ready for the unknown, and not just one time, because things kept changing and being new. And then it was supposed to be maybe a crisis that would last a few months, and then it's going on, and there was a first wave, and there is a second wave. So probably, I would say the biggest lesson learned or the biggest challenge to keep that compliance is to be more and more agile and more ready for the unknown, because we actually still don't know what will happen next month, next year, and how much that compliance and that new way of working, remotely, will actually, we don't know how long it will last. It could last for another couple of years. That's what I would say.
Thanks very much. So we have another question from the audience. How do you find the increasing importance of risk governance management in non-financial banking sectors? For example, manufacturing, operations, and supply chain. Michael, can you take that one?
Yeah, sure. So we've seen a really interesting trend in governance, risk, and compliance where, frankly, the large financial institutions are usually the first ones to have to adopt a given set of regulations or compliance stances and so on. But that inevitably gets pushed down to large public companies. Again, they're looking for investment. They're looking to get the banks on side with investing in them and the institutionals and so on. And so they all end up in a position where they take on a similar stance and a similar approach to risk management. And now that's going to move further and further down market. And that's also led to a spread, if you would, of how governance, risk, and compliance is managed by all industries. So you could be in an airline, you could be in food processing, you could be in shipping. And all of those companies are all now looking for proper, risk management processes and plans and people and so on, because they're all trying to ensure that when they're looking for investment or they're looking for banking or they're looking for anybody to give them money, they frankly need to have some kind of governance process in place that's going to make them a far more attractive place for somebody to invest. If you're trying to invest in a company, would you rather invest in one that has a sound risk management process or one that does not? And so we're starting to see a lot of even smaller companies now where we've actually seen where traditionally most of our clients have all been Fortune 500s. We're starting to get an awful lot of small startup fintech type companies are coming to us and saying, hey, we're a tiny digital bank. We have, 30 people who work for us, and we've got maybe, a couple thousand clients at this point, but we're growing and we're trying to attract investors. And now we need to have a GRC program put in place. Whereas this is something that, if you went back 10 years, some of the larger financial institutions on the planet, we're still trying to figure out, do we need a risk management program at all of some kind, right? And now we're seeing that now in the smallest companies. And I think that's a really interesting trend. Obviously, it's great for us in our business, but I think it's going to open up a huge number of opportunities for people who want to be in this space. And, I think that's a trend that's just going to accelerate. And I suspect where we'll end up is that pretty much any company is part of a straight up startup or entrepreneurial process. Risk will be a major consideration of how that company gets started. And that's something that we haven't seen traditionally.
Thank you very much. Another question from the audience. What do you see as the risk trends comparing virtual banks and traditional bank? Do you foresee similarities or differences? Basil?
Thanks, Sylvie. Look, from my perspective, banks are banks. And generally, the risk profile of banks tends to change based on size, scale, liquidity, these types of things. All your traditional banking risks tend to apply across both virtual and non-virtual banks. Where banks, the risk associated, or some of the more acute risk associated with virtual banks probably relate to channel, obviously, and these are the risks associated with obviously delivering your financial services products through a particular channel, obviously being online. Now, lots of risk managers on the call, risk professionals understand how this works. Realistically, the more significant risks associated with directing a lot of your business or your volumes through an online or kind of direct channels that aren't face-to-face are fairly standard. Disclosure risks, accessibility, security as well, because there are certain issues associated with customer identification, general data risk, KYC, and certain liability management to a certain extent. Again, banks are banks. They carry the same risks. They're generally regulated in the same way. I would say, though, there are some unique or more acute channel risks, and one would expect a risk manager working for a virtual bank to have some of those risks more highly rated and probably have a more robust control environment in relation to managing the channel risk associated with online.
Thank you very much. Can I now ask each one of you to summarize in 3 keywords?
Oh, right, I'll go first.
No. Okay. Oh, yeah. Why don't you go first? Thank you.
That's fine. I'll last and first. Thank you again for the opportunity to be part of this. From my perspective, Sylvie, I think if I was looking at 3 things, particularly after the advent of the pandemic, my view is that all elements of your risk management framework need to be matured. So you need to actually extend the maturity from the core to some of the outer reaches, particularly in the areas of business continuity, obviously quantitative risk kind of assessment, some of the areas you might focus on. I think you need to be not wary, but you need to be mindful of the fact that the increased sophistication and resourcing associated with regulators, and you need to be live to that. They're just getting better, which is a really good thing from a consumer protection perspective. That's a positive. And then probably the last point is just focusing on the things that matter. Realistically, testing, if you don't have the capacity, we can't do everything. And particularly, I think Sophie raised it earlier, in the context of a pandemic, because you can't do everything. You need to focus on the things that matters and focus on security, staff safety, and some of the more important elements of the operational risk management framework.
Thanks very much. Sophie?
Yes. So actually, I so agree on that conclusion of prioritization. So what I would say in terms of lesson learned after living through a pandemic and working with risk managers is trying to summarize to 3 priorities. Because there is that need to comply to more and more regulation, a trend of consolidating everything in one single system is pretty key to be more efficient and also to save on costs. So that would be 1. 2 would be probably look for optimization tools because there are so many new components that will affect your portfolio, your profitability, that an optimization tool will be what helps you navigate through all those parameters that are all coming at the same time, right? And I would say my last conclusion is what we have learned from this pandemic is that we have to be ready for the unknown. We don't know what will happen. So being ready for the unknown means having a very agile way of managing risk, of managing systems, and of just being ready to manage a new risk every day. That would be my last conclusion.
Thanks very much. And Michael?
I think we come back to some of the comments that we made towards the beginning around how right now the various jurisdictions are really making life a bit difficult for risk managers. And I would number one, I would very much like to see, even if it's not a gap type of solution, which I agree with Vasil would be extremely difficult to bring into place across all the regions. I agree. While that would be a very difficult thing, I think that would probably be the utopian solution that I'd like to see put in place. Number two is certainly that continuing trend of risk being pushed down into other industries and smaller organizations. I think that's a trend that's going to continue, and frankly, for all of us in the risk industry, that's great. It means more work for all of us, so that's wonderful. But on and then the last one, I still think comes back to the technology, and obviously that key technology piece that everybody is talking about these days, which is really AI and what it can offer. And right now, like I said, it has certain very niche requirements, but it's far more of an intricate automation tool at this point than anything that's going to offer true intelligence or any kind of intuitive leap or lateral thinking type of thing. It's not an intelligence tool yet. It's still very much a fancy automation tool. A talented one, yes, but not one that could really take over for people other than in just bulk situations where there's a huge amount of data to absorb and parse. So I'm very keen to see AI mature, and see where it can go. I do believe that as a concept and where it's at as a technology, there's a lot of really exciting things happening. But it's not there yet. The marketing hype is outweighing the deliverable at this point. And, but that said, I mean, who knows? I mean, we might be 6 months, a year, or 2 years away from seeing that mature into something extremely useful. So those are kind of my takeaways for today anyways.
Thanks very much. Sorry, Gaurav, we're already running over time. So just quickly.
No worries. I'll anyways go for scraps. See, from my perspective, there is genuinely a major shift towards hosted technology, which allows banks to scale up the risk management framework quickly and efficiently, right? And to Sophie's point earlier, one consolidated risk view to actually meet regulatory demands. And the second thing very quickly is on the data and pricing model consistencies that clients would really look at across the workflow. That's it. I guess I couldn't agree more with the rest of the panelists. The journey has just begun. Everyone should just sit back, tighten the belts, and look at the next 3-4 years for regulatory compliance.
Thanks very much. So thank you for all the questions. Unfortunately, we can't address them all, but we will get back to you offline. Thank you very much for listening. Thank you to the panelists for participating, and thank you to the Asia Risk for organizing this event. Please stay tuned for the Asia Risk Congress in 2020, which will be held virtually November 24th to 27th. And have a nice rest of the day. Thanks.